Most beginners get into futures trading thinking it's a fast way to make money. Low capital, quick movements, big upside. But the reality is this. Most trading accounts don't even last 30 days. In this video, I'm going to break down what futures actually are in simple terms and why so many traders end up blowing their accounts before they ever become consistent. So first, what is a futures contract? A futures contract is just an agreement to buy or sell something at a specific price in the future. But as a trader, you're not actually trying to own anything. You're only trading the price movement. For example, with S&P 500 futures, if you think the price is going up, you go long. If you think it's going down, you go short. And as the price moves, you either make money or lose money. That's really all it is. Now here's why futures attract so many beginners. You can start with relatively small capital. The market moves quickly, and you can profit in both directions. On top of that, prop firms make it feel like you're one step away from getting funded and trading large accounts. But this is where things start to fall apart for most traders. Futures are highly leveraged. That means even small price movements can create large gains, but also very fast losses. And most beginners don't fully respect that. They start trading too many contracts too early. They don't define a daily loss limit. They revenge trade after losses. And they treat trading like a shortcut instead of a structured process. You'll often see the same cycle repeat. A trader passes a small evaluation, gets excited, increases size too quickly, hits a drawdown day, and the account is gone within a week or two. Not because the strategy didn't work, but because risk wasn't controlled. Instead of focusing on consistency, they focus on one big win that changes everything. But trading doesn't work like that. The traders who actually last take a different approach. They focus on protecting capital first. They stay consistent, and they think in terms of survival, not excitement. Because in trading, survival comes before anything else. One approach I personally use is trading just a single contract. It reduces pressure, it forces discipline, and it makes it much harder to blow up an account in a single day of mistakes. It's not exciting, but it's sustainable. And over time, sustainability is what actually builds consistency. If you're trying to pass evaluations or break out of the reset cycle, I've put together a short structured guide that explains this approach in more detail. You can find the link to my website in the description below. I also have a free trade tracker in Google Sheets you can download. Thanks for watching, and remember, keep it simple. Manage risk first. Let the math do the rest. Good luck in your trading.